Hi, I'm Jimmy. In this video, we're looking at a new portfolio that I'm setting up. So I recently did a video on my long-term buy and hold portfolio where I introduced the idea of creating a new portfolio. So this video is designed to set up, let's call it, map out the guidelines for how this new portfolio, how we're going to find companies for this new portfolio. So the goal of this new portfolio is to find high quality companies. Now, I plan on being less intrinsically value driven than I am in my long-term buy and hold portfolio. The portfolio that gave me this performance for the past couple of years, pretty good, but I want to buy more high-quality companies, or at least be able to identify more high-quality companies that are hopefully trading somewhere near their intrinsic value. Now, I want to be diversified in as many sectors as I can, or at least where I can find high-quality companies that I wouldn't mind holding for at least a few years. So the plan for the portfolio is to have somewhere between, let's say, 20 and 40 different companies. Early on, we're going to clearly have less than that as we're doing the research, and kind of building up. We're going to start with one, then two, then hopefully build up. But eventually, somewhere between 20 and 40 is where we expect to land from a, let's call it a broad range perspective. So the real question is, how do we define high quality companies? Well, what numbers can we lean on to help us identify what a high quality company is? So with that in mind, I've created a few guidelines that I plan on following when searching for these high quality companies, when I'm doing a deep dive on each company. Okay, so the first guideline that I plan on looking for is I'm looking for companies that have a high return on equity or high return on invested capital. Both return on equity and return on invested capital are ways to see how effectively a company generates profit from the capital it uses. Return on invested capital, ROIC for short, is how effectively a company can generate profit from all of the money that they have invested in the business. So think all debt and all equity. What are the returns compared to that? And then return on equity is really just comparing how effectively a company generates profits compared to just shareholder equity. So although both are good and both can provide good insight, depending on what industry we're looking at, well, one metric could be a lot better to consider than the other. So this is why we're in this instance, we're saying either or. Hopefully both look pretty good, but some industries might not act the same. Return on equity, return on invested capital wouldn't necessarily act the same. For example, many times with a capital intensive industry like, let's say, utilities or telecoms or airlines, something like that, well, return on invested capital can often be better. If you have a more asset light business, maybe a bank or an insurance company, or even like a software as a service business, well, something like that, return on equity could be a better method to use. Now, this is just one example of why it's important that we don't get too hooked on, or let's say get too hooked on hard and fast rules. For example, I'll only buy a company if return on equity is above X. Well, that could be dangerous because, well, not necessarily dangerous, but what could happen is you could end up leaving out a lot of great companies because perhaps return on equity isn't best suited to be compared, to that particular company or that particular industry. So we're going to be a little bit flexible with those ones. So as we go through these different guidelines that we're going to use to follow the rules for building the new portfolio, just be aware that we are going to make some adjustments from company to company and industry to industry to help apply the metrics that are most important to that specific industry. Of course, we'll be making videos throughout this entire process. So if you're curious about how different companies, the metrics better for some industries or some companies than others, we'll go through all of that. Okay, now for our next guideline or our next rule. Here, we're looking at growth and stability. So we're looking for growth and stability think of numbers like revenue, profit, free cash flow, operating cash flow, things like that. The idea is to find companies that have reliable and even predictable numbers. So ideally, a company that, if you were to look at a chart of the company's revenue, a company that is sloping upwards with minimal variation can be very useful. It makes predicting free cash flow, predicting revenue much simpler if they do it in a fairly steady way. Compare that in your mind to a company where revenue's, up $1 billion, down $5 billion, up $7 billion, down $2 billion. We're not really looking for that. And related to this, we're actually looking for companies that also have strong profit margins. We have gross profit margins, operating profit margin, and net income profit margin. So bottom line profit. Ideally, we want profit margins to be relatively strong. Now, Warren Buffett once stated, he stated a whole bunch of times, but he has stated in the past that oftentimes we can use profit margins as a sign of whether or not a company has a moat, or how strong is that company's position. If you look at profit margins, a lot of times that can give you good insight. For example, a company like Microsoft has high profit margins. If you were to compare that to a company, an industry like airlines, they're very price driven. They're always competing for the lowest possible price. And because of that, profit margins are very small. So we're looking for companies that have, relative to their industry, relative to their peers, strong and stable and hopefully high, maybe even growing profit margins. Okay, now along these same lines, over on the Investors Grow website, well, we actually created a line item for stability. And these stability numbers could look at something like revenue stability or net income stability or free cash flow stability, different things like that. To illustrate how this works, this is a chart of Microsoft's revenue stability number. And you can see that it's quite high. So the whole premise of this is to try to make it simple to visually see how reliable the company has grown revenue, in this case, revenue. Well, closer to 1. 1 is the perfect number. 0, really bad number. So higher is better. And we can see that Microsoft has done a very good job of keeping revenue stable. But when we jump in and look at their free cash flow stability, again, they have very high number. This is a rolling average. This is a number that looks at historical, in this case, we're going back the past 10 years. And we can see that free cash flow has been very predictable for Microsoft. But what if we were to compare that to a company that has, let's say, a little bit less predictability within the free cash flow numbers? Well, one example could be a company like Southwest Airlines. Southwest Airlines, as we just mentioned, is a highly competitive industry, driving for lowest possible price, smaller margins. And we can see that their stability number, not only is it bad, but it's been getting worse. So clearly the goal of the stability number is to use that as a way to kind of rule out companies that could be bad. It's designed to make it a little bit simpler and easier. Okay, moving right along. So the next one we're looking for relatively strong shareholder yield. So shareholder yield is a combination of dividend yield and net stock buybacks. So companies might issue shares. Let's say they issue shares for maybe stock options, but they also buy back shares, but they also pay a dividend. These are all different ways to return funds back to the investor, either through buybacks and dividends. So ideally, a strong shareholder yield indicates better returns for investors. Okay, the next one on the guidelines list is debt levels. Here, we're defining this as reasonable debt levels. That's kind of vague because, again, this could vary wildly. What is reasonable could vary wildly from industry to industry or company to company. Now, to come up with this, we can look at numbers like debt to equity or debt to assets, or even something like interest coverage ratios to see if it makes sense that whether or not the company can afford to pay their interest. Ideally, we want them to be able to afford to pay their interest and hopefully have lower debt levels. But again, not all debt is created the same. For example, let's imagine a company just went out and spent $50 billion on an acquisition of another company. And to do that, they had to do a big debt issuance. So debt jumped up. Well, that shouldn't necessarily rule them out from an investment standpoint. So I have no intention of having kind of a hard and fast rule for debt, like debt can't be over, 5% of market cap or some, 10% of revenue, whatever it is. I have no intention of doing that. I plan on strategically looking at debt, depending on the company, depending on the industry, depending on the situation, and then seeing whether or not that debt is reasonable. Again, I'll make videos about all the companies that we put into this portfolio as we go along, and hopefully I can explain what I'm thinking and why I'm thinking. So this is the summary of the rules that we're going after. And with the market being down as much as it is right now, this is one of the reasons that I'm kind of chomping at the bit to get this portfolio started, because I think that this has the potential to be a real opportunity that many of us can take advantage of if we can go through and find good, high quality companies, hopefully with the market pulling back as much as it has recently, hopefully at a good price. So I plan on starting to publish some videos very, very soon about the companies that are going into this portfolio. So if you have any ideas for companies that I should look at, that we should research, please let me know in the comments below. And if you want to sign up to get access to the Investors Grow website, I will leave a link for that in the description below as well. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.